All right, let's talk about something that can be a real headache for pretty much every investor: taxes. We're going to tackle two forms that cause a lot of confusion: Form 8949 and Schedule D. My goal here is to make this whole thing super clear for you.
So if that's you, you are in exactly the right place. And getting these sales reported correctly, it's not just important, it is absolutely crucial. So let's make sure you've got it down, Cole.
And I promise, we're going to do this fast. In the next 5 minutes, you'll have a clear, no-fluff guide. Sound good? Okay, let's jump right in.
All right, first things first. Let's meet our two main players here, Form 8949 and Schedule D. Seriously, once you understand how these two work together, everything else just clicks into place.
The easiest way to think about this is with a simple analogy. Form 8949, that's your itemized receipt. It lists every single sale. And Schedule D, well, that's the final summary, the big total at the end of the receipt.
And the information flows in a really logical way. See, it all starts with your individual transactions. From there, they go on to Form 8949. Then, all those details get summed up on Schedule D. And finally, that one big number from Schedule D, it goes right on to your main tax return, the good old Form 1040.
Okay, so let's dig into that first piece of the puzzle, Form 8949. This is where we get down to the nitty-gritty, the real details of every single move you made.
The one thing you have to remember about this form is that it's all about specifics. The IRS isn't looking for a summary here. They want a line-by-line report. You can't just lump things together. Nope. Every single trade needs its own line item.
So what kind of stuff are we talking about here? Well, it's pretty much what you'd expect. You've got your usuals, right? Stocks, bonds, digital assets like crypto, all that goes here. But it also covers some of the weirder stuff, like a non-business bad debt, or even if one of your securities just went completely worthless. Okay, and here's a super important step. Before you even touch Form 8949, you've got to sort everything you sold into two piles, short-term and long-term. The magic number is 1 year. Held it for a year or less, that's short-term. More than a year, that's long-term. And trust me, this distinction is everything. We'll see exactly why in just a minute.
All right, so you've done all the hard work. You've listed every single transaction on Form 8949. Now it's time to zoom out to see the big picture. And that, my friends, is what Schedule D is all about.
So if Form 8949 was our itemized receipt, then Schedule D is the final bill. It takes every one of those individual gains and losses, mashes them all together, and spits out the one number that really matters, your total net capital gain or loss for the year.
So Schedule D starts by pulling in the totals from Form 8949. But that's not all. It also grabs other things like capital gain distributions you might get from a mutual fund, or maybe gains you had from a partnership. And this is a big one. If you had a loss last year that you couldn't use, this is where that capital loss carryover comes into play.
Now listen up, because here's a little pro tip that could save you some time. For some people, you might be able to skip Form 8949 altogether. How? Well, if your broker's 1099-B form has all the right info and it's already been sent to the IRS, you might just be able to pop those totals right onto Schedule D. It's a fantastic shortcut, but you have to make sure you qualify.
Okay, we've been talking a lot about gains, which is fun, but let's be real. Investing isn't always a one-way street up. So let's talk about a super common situation. What happens when you add everything up and you're in the red?
It's a question a lot of people have, right? You do all the math on Schedule D and that final number has a minus sign in front of it. So does that mean a giant tax break is coming your way? Well, not exactly. There are some very specific rules we need to talk about.
This is the number. If you remember one number from this whole section, make it this one: $3,000. That's the magic number.
So here's the deal. That's the maximum amount of capital loss you can use to reduce your other income, like your paycheck, in a single year. Oh, and it's half that, just $1,500 if you're married filing separately. So let's say your total net loss was $7,000. You get to use $3,000 of that to lower your taxable income this year.
But wait, what about the other $4,000? Does it just vanish? No way. And this is the cool part. The IRS lets you carry it over to future years. You can use it to cancel out capital gains next year, or if you don't have gains, you can use it to deduct another $3,000 from your income then. You just keep carrying it forward until it's all used up.
Okay, enough about losses. Let's get back to the good stuff. What happens when your Schedule D shows a net gain? This is where that whole short-term versus long-term thing we talked about earlier becomes, well, everything.
Here's the bottom line, the crucial point. Long-term capital gains are almost always taxed at lower rates than your regular income. This is maybe the biggest tax advantage available to investors. Holding on for just over a year can save you a ton of money.
Now, it's not quite that simple, of course. Not all long-term gains get the same treatment. For most of your investments, stocks, mutual funds, that kind of thing, the tax rates are either 0, 15, or 20%, which is great. But look here. Gains from selling collectibles or certain types of real estate, they get hit with higher rates. So what you're selling really does matter.
So let's just recap that, because it's so important. Short-term gains, they just get dumped on top of your regular income and taxed at whatever your normal rate is. Ouch. But long-term gains, they get those special, lower capital gains rates. That's it. That's the fundamental difference that drives so much investment strategy.
Okay, so if your brain is full and you can only take away one thing, make it this sentence. Form 8949 is for the details. Schedule D is for the total. Your losses have limits, and your long-term gains have benefits. Got it? That's the whole game right there.
Look, getting a handle on these forms isn't just about doing your taxes from last year. It's about looking ahead. Now you have the knowledge to make smarter choices about when to sell things in your portfolio. So I'll leave you with this question. You've got the map now, so how are you going to plan your journey?